You're scrolling through social media, and a charismatic financial guru pops up on your screen, passionately explaining why a Roth IRA is the ultimate wealth-building secret that the government doesn't want you to know about. They flash bright graphs showing how a simple $500 monthly contribution can magically turn into over $1 million by the time you retire, completely tax-free. It sounds like the perfect financial escape hatch. A foolproof plan to secure your future while keeping Uncle Sam's hands out of your pockets. You get excited, open an account, and start funneling your hard-earned dollars into it, believing you've just cracked the code to financial freedom. But what if that shiny, perfect picture is missing some critical, expensive details? While a Roth IRA isn't an illegal scam in the traditional sense, the way it is aggressively marketed can feel like a massive illusion that traps your money and severely limits your real-world financial potential. Let's break down the biggest selling point that everyone falls for: tax-free withdrawals in retirement. The guru tells you that because you pay taxes on the money now, you won't pay a single dime when you're 65. That sounds amazing if you assume you'll be in a much higher tax bracket later in life. But for many average earners, this is exactly where the math starts to work against you. Imagine you are earning $60,000 today, which puts you squarely in a 22% federal tax bracket. If you decide to contribute $7,000 into a Roth IRA, you actually had to earn roughly $8,970 before taxes just to have that $7,000 left over to invest. That is nearly $2,000 gone to taxes immediately. Money vanished from your pocket before it ever had a chance to grow. If in retirement, your lifestyle changes and you only need to draw $40,000 a year, your effective tax rate could be significantly lower, maybe around 10 or 12%. By choosing the Roth option today, you essentially volunteered to pay a higher tax rate now rather than a lower one later, costing yourself thousands of dollars in upfront wealth-building power. This upfront tax hit introduces a massive, silent penalty known as opportunity cost. If you had chosen a traditional, tax-deferred retirement account instead, that full $8,970 could have been working for you from day one. That extra $2,000 left in your account, compounding at an average annual return of 8% over 30 years, grows into an additional $20,000 just from that single year's contribution. Multiply that difference over decades of working and investing, and you realize you are leaving hundreds of thousands of dollars on the table during your peak earning years. The illusion is that you are saving money on future taxes, but the reality is that the hype blinds you to a simple truth. Pre-tax investing allows you to invest more money sooner, letting compound interest do the heavy lifting on a much larger principal sum. You are shrinking your seed money before you even plant it. Then there is the trap of liquidity and rigid rules that no one likes to talk about. The financial media loves to praise the Roth IRA because you can withdraw your original contributions at any time without penalty. What they whisper in the fine print is that the moment you touch the actual earnings, the growth and interest your money has made, before you turn 59 and a half, you face a stiff 10% IRS penalty plus standard income taxes on that growth. If your $7,000 investment grows to $15,000 and you face a sudden medical emergency, a job loss, or a time-sensitive business opportunity, trying to access that full $15,000 becomes a bureaucratic and financial nightmare. Your money is effectively locked in a vault, held hostage by age requirements, preventing you from using your own capital to pivot or survive unexpected life events when you need it most. Furthermore, the contribution limits are painfully low, acting as a ceiling on your ambition. Limiting your investments to around $7,000 a year means that even if your stock picks or index funds perform beautifully, you are heavily restricted in how fast you can scale your wealth. If you have a spectacular financial year, perhaps from a side hustle or a bonus, and you want to dump $20,000 into your retirement vehicle to maximize your momentum, the Roth IRA slams its doors on you. It forces you to look elsewhere, breaking your stride and complicating your strategy, while other investment vehicles offer much higher thresholds to absorb your success. We also have to talk about the grand gamble of trusting future government policy. The entire premise of the Roth IRA relies on a promise made by Congress today that they won't tax your withdrawals 30 years down the road. But federal debt is soaring into the tens of trillions, and tax laws are rewritten constantly to adapt to economic crises. There is absolutely no guarantee that a future, cash-strapped government won't implement a new form of national sales tax, a wealth tax, or simply change the rules on high-balance Roth accounts to generate revenue. You are paying a guaranteed tax premium today in exchange for an unregulated, politically volatile promise for tomorrow. If the rules of the game change when you are 60, you can't go back and undo the taxes you eagerly paid in your 20s and 30s. So when the next financial guru tells you that a Roth IRA is the only correct path to wealth, remember that personal finance must always be personal. For ultra-high earners or those expecting a massive systemic change in tax structures, it might make sense. But for the everyday investor, blindly following the trend without calculating your current tax bracket versus your future one, ignoring the low contribution ceilings, and forgetting about the power of upfront tax deductions can cost you a fortune. Real wealth isn't built on trendy financial products whispered by influencers. It's built on maximizing the efficiency of every single dollar you earn today so it can fight for you tomorrow.